Chapter 20, we'll be talking about inventory management in this chapter. So the first thing we're going to do is we're going to look at the 6 categories of costs that are associated with goods for sale. We're going to look at what's known as the EOQ, or the Economic Order Quantity Decision Model. And then we'll look at some of the effective errors that can arise when we use this model and some ways that we can reduce conflicts pertaining to performance evaluation. Inventory management then will include planning, coordinating, and controlling activities that relate to the flow of inventory. And this flow of inventory will be into, through, and out of an organization. There are a number of different types of costs that are associated with inventory other than the cost of the actual goods purchased. We will be discussing the following costs: purchasing costs, ordering costs, carrying costs, stack-out costs, quality costs, and shrinkage costs. Purchasing costs then would be the cost of goods that's acquired from our suppliers. This would also include any incoming freight costs. This is typically the largest cost category of goods in our inventory. When we look at ordering costs, these would be the costs of preparing and issuing the purchase orders for inventory. It will involve receiving and inspecting the items that are included in the orders, matching any invoices that are received. It has to do with purchase orders and delivery records that we will use then to go ahead and make payments for this inventory. When we look at carrying costs, these are costs that will arise when goods are being held in inventory. These costs will include opportunity costs, which we'll get into in a little bit, of the investment that's tied up in our inventory, and costs that are associated with storage. So, for example, what the warehouse will charge us to store goods. Stock-out costs would be costs that arise when a company runs out of a particular item for which there is consumer demand for. These are known as stock-outs. The company must act quickly to replenish inventory to meet that demand, or they'll suffer the cost of not meeting it. That would be basically lost sales. It could contribute to lower margins, and it could also affect the reputation of a company. So companies want to minimize their stock-out costs. Costs of quality then are costs that are incurred to prevent and appraise, or they're costs that arise as a result of quality issues. In Chapter 19, we talked about some of these quality costs that include prevention, appraisal, internal failures, and external failures. Shrinkage costs are costs that result from theft by outsiders, by embezzlement or stealing by employees, and or misclassifications or misplacement of inventory. The way that we calculate shrinkage is the difference between the cost of inventory that's recorded on our books versus the cost of inventory when we physically count it. How much should a firm order of a given product? In order to determine this, they will use the EOQ, or the Economic Order Quantity Model. And there will be a given set of assumptions that will be used to calculate what the optimal quantity of inventory should be to go ahead and order. Let's go ahead and take a look at some of the basic EOQ assumptions then. The simplest version of the EOQ model assumes that there's only 2 costs: ordering and carrying costs. The same quantity will be reordered when we're getting close to running out of inventory at what's known as the reorder point. Demand, ordering costs, and carrying costs will be known with certainty, as is the purchase order lead time. Again, that's the time between placing an order and its delivery. Purchasing costs are going to be irrelevant in the economic order quantity model. We will also assume no stockouts occur, and then managers will consider the costs of quality and shrinkage costs only to the extent that these costs affect ordering or carrying costs. So the formula for EOQ looks like this: the economic order quantity is equal to the square root of 2 times D. D is the demand in units for the product. P is the relevant ordering costs per purchase order, and then we're going to go ahead and divide that by what the relevant carrying costs are. Again, we take the square root of that and we come up with the economic order quantity. This last bullet point is very important. Relevant total costs will be minimized when relevant ordering costs equals relevant carrying costs. So in the next slide we'll get into and we'll show what ordering costs look like and what carrying costs are. But one more time, relevant total costs, that's what we're using the EOQ model for to determine how much inventory to purchase, will be minimized in this model when relevant ordering costs are equal to relevant carrying costs. If we were to go ahead and graph this function, then the point where our annual relevant total cost is at its lowest is going to be the economic order quantity unit that we should have. So here it's going to be relevant total cost of $5,200 for the purchase of inventory, and we need to go ahead and purchase 1,000 units of that inventory. Notice that there are two components then that are going to make up the annual relevant total costs. The total cost will be made up of the annual relevant ordering costs plus the annual relevant carrying costs. Again, what we're trying to do is we're trying to find where these two are equal to go ahead and minimize what our relevant total costs will be. When we look at our annual relevant carrying costs, notice that if we take our quantity and we go ahead and we multiply that by the relevant carrying costs and we divide that by 2, we could go ahead and graph that. Notice that Q is in the numerator, so as our Q increases, we're going to see this line continue to increase as well under our carrying costs. Under annual relevant ordering costs, notice that Q is also in the formula, but notice that Q is in the denominator. So in order to calculate our annual relevant ordering costs, we're going to take the demand in units, we're going to multiply by what the relevant ordering costs per purchase order are, and we're going to divide by Q. So notice that as Q continues to increase, since it's in the denominator, our annual relevant ordering costs will also be downward sloping. They will go ahead and decrease as well. So if we put these two together, if we put together our annual relevant carrying costs plus our annual relevant ordering costs, we could come up with our annual relevant total cost, the sum of the ordering costs plus the carrying costs. And notice that it will start down sloping. So here we see the effect of our annual relevant carrying costs getting to the point of EOQ, and then after that we're going to see that it will start to increase due to the annual relevant carrying costs taking over. So again, our annual relevant total cost, this point here, is made up of our annual relevant ordering costs. That will continue to decrease until we hit EOQ. Once we hit EOQ, then it starts to increase because the annual relevant carrying cost is going to take over. It's going to be more powerful than the annual relevant ordering costs. Okay, the second decision in managing goods for sale is when we need to order a given product. This is what we call the reorder point. It's the quantity level of inventory on hand. When we get to that certain lower level, that triggers a new purchase order. So the reorder point is simplest to compute when we know both demand and the purchase order lead time. So our reorder point, then, the formula is going to equal to the number of units sold per unit of time times our purchase order lead time. So if we knew that if we were to take our annual number of units sold, and let's just go ahead and convert that to how many units are sold on a daily basis, so we would go ahead and divide by 365. That would give us the number of units sold per day if we did that calculation. And then if our purchase order lead time, let's assume it was 10 days to get that inventory back in, well then we would simply go ahead and we would multiply the daily demand times our purchase order lead time. So whatever that daily demand is times 10, that would give us our reorder point. If we were to look at a graph of that, it would look like this. If we knew that our reorder point was here at the 2 week time, we would go ahead and put in our order. And if we recalculate our reordering point to be 2 weeks out, then we would be getting our inventory out here at 4 weeks. Again, in this example, if we assume a lead time of 2 weeks, if our EOQ is at 6 weeks, then we would need to go ahead and reorder at this point so that we get the inventory out here at the 8 week period. Safety stock is inventory that is held at all times, regardless of the quantity of inventory that we order using the EOQ model. So what safety stock really is it's just a buffer. It's additional inventory that we keep on hand to help guard us against unexpected increases in the demand for our product. There may be uncertainty about what our lead time is, how long it actually takes us to get additional product, and if there is potential shortages where we can't get additional stock from suppliers, then we would again keep that safety stock. We can use past data by using some tools such as a frequency distribution to go ahead and figure out what safety stock levels that we should keep on hand. So we're using past data to determine our safety stock levels. Companies are also getting increasingly sophisticated at understanding their customers using techniques such as design thinking and data analytics. So data analytics involves data mining. It's using that data to help predict what our customers are going to buy, when they're going to buy it, and when we need to make sure we need to reorder additional product. So this deeper understanding will help us reduce uncertainties about demand that companies face and the need to hold large quantities of safety stock. Again, we want to minimize the amount of safety stock that we hold because of the cost associated with it, but yet we need to guard ourselves against increases in unexpected demand or unavailability from suppliers. Okay, when we estimate inventory-related relevant costs and their effects, we're going to look at three different costs. One will be carrying costs, which we'll talk about on the next slide. We look at stock out costs. This is when we have to go ahead and expedite an order from supplier, so it's a rush order, which will typically involve additional expenses such as getting the product shipped to us overnight. As you're probably familiar with FedEx, if you want to ship something overnight, it's going to cost more money than if you're willing to wait 2 or 3 days to have that good received by the other party. Ordering costs are those costs that will change with the number of orders placed. Let's go ahead and look at carrying costs. And carrying costs are relevant inventory carrying costs that consist of incremental costs and relevant opportunity costs. So first of all, let's take a look at incremental costs. These are the costs of the purchasing firm that change with the quantity of inventory held. So as we hold more and more inventory, that could affect shrinkage levels, what is stolen or what is embezzled by employees or other outside people. It could involve an additional warehouse rent that we have to pay if we're taking up more space. Holding on to more inventory, we have to insure that inventory, so that's going to increase our insurance costs. There's also the possibility that our inventory could be broken. And then we also have to go ahead and pay worker salaries, and we would also be stuck with the cost of obsolescence. This is where we have inventory that we can't sell because it's obsolete. So if we had an inventory warehouse full of, let's say, really old computers, we're pretty much stuck with them. No one's going to buy them because they're obsolete. Everybody wants the new top of the line computer or something that's more recent. Relevant opportunity cost of capital then would be defined as the return foregone by investing capital in inventory rather than elsewhere. It just means that if we have a limited amount of capital, limited amount of money, we can either go ahead and invest it in, let's say, stocks and bonds where we may get a return of, let's say, 10%, or we could go ahead and we can invest it in inventory. And what we need to do then is we need to calculate what that inventory carrying cost is going to be, how much we could sell the product for, and then compare that to that 10% rate of return that we may get on stocks and or bonds. So if we can get a greater than 10% return by buying inventory, holding it, and selling it, then we should do that. If we can't, then we're foregoing that 10% return that we could have gotten from stocks and bonds. Whatever our return is going to be, it's going to be something less than that 10%. Okay, cost of a prediction error. Predicting relevant costs is difficult. It's more of an art than a science. So the question that's raised is, what is the cost when actual relevant costs differ from the estimate relevant costs that we use for decision making? Well, there are 3 steps in determining what the cost of a prediction error is. First of all, we compute what the monetary outcome is from the best course of action that could be taken. So this is given the actual amount of the cost input. We would then go ahead and compare that to the monetary outcome from the best action that's based on what the incorrected predicted amount of the cost input was. So the difference between these two would be our prediction error. How much we actually paid versus how much we predicted we would pay. There could be conflicts that arise between the EOQ decision model and manager's performance evaluation. So an example of this is that the EOQ model takes into account opportunity costs because they're considered relevant costs when we calculate the inventory carrying costs. However, managers are evaluating financial accounting numbers. The financial accounting numbers do not include the opportunity cost. So again, some managers may go ahead and they may try to make their performance look better because it's based purely on financial accounting numbers. They don't have to worry about what those opportunity costs are. So one way we can get around that is to go ahead and charge managers when we look at their performance evaluation for what those potential opportunity costs were if the manager decides to hold higher levels of inventory. So if they do decide to hold those higher levels of inventory, there's going to be a cost associated with doing that. That can't be picked up just by looking at the inventory carrying costs based upon financial accounting numbers, based upon the balance sheet and the income statement. So managers that are interested in making their own performance look better will only focus on those measures used to evaluate their performance. Conflicts could arise then between what the EOQ model's optimal order quantity is and what the order quantity is that managers regard as optimal. Why? Because those opportunity costs are being taken into account to more fairly evaluate managers' performance. Okay, that will go ahead and that will end this podcast.